SAMHI is India's third largest owner of hotel rooms. We started the company in late 2010, early 2011. So it's just been about 12 years since inception. And within those 12 years, we have created a company which has 4,800 rooms across 31 hotels, 13 cities. As I said, that makes us the third largest owner of hotel rooms in India. Our business model is that even though we are a very large hotel owner, we actually don't build many hotels. So our fundamental strategy is to identify underperforming, undermanaged hotels. We will acquire those hotels, and post-acquisition, we do a turnaround. And typically that turnaround will include making material changes to the product, bringing a strong brand, so that combination of the product and the brand can help us reposition the hotel in a different, I would say, price point. Then we have proprietary asset management tools which help us asset manage our hotels really well. So that's how we've been able to build a very large portfolio. Now, we have seen some very clear advantages of an acquisition-led strategy. One of them is we can build a company faster. As you know, development takes anywhere between 3 to 5 years, by the time you can get to complete a hotel. Whereas in an acquisition, you can really put inventory in the market at a much more rapid pace. The second advantage is that since we are not building hotels and we are buying hotels, let's say, I'm simplifying, but let's say you buy a hotel which is in 3-star category, using some bit additional investment and rebranding, you position it in the 4-star category. So suddenly what happened is that you paid the price of a 3-star and you get the value of a 4-star hotel. So that helps us keep our cost per key at a reasonable discount to what would otherwise be a replacement cost. We always will have a tie-up with an international hotel company or a brand. And I would include some of the large hotel companies in India to be international now in terms of their scale. So our business model is we focus on ownership and asset management. We focus on identifying opportunities, creating this turnaround. But as far as day-to-day operations are concerned, we always partner with an operating partner like Marriott or Hyatt Hotels or IHG. And we would obviously use their brands for our hotels to operate under. As of 31st March, we had partnerships with Marriott for multiple brands across their portfolio, but we own 43% of all Fairfield by Marriott hotels in India. So pretty large relationship there. Similarly, we also own about 71% of all Holiday Inn Express hotels in India, which is a brand of IHG hotels. And then we have 2 hotels with Hyatt as well. So that's really been our acquisition strategy. We combine it with strong brands. And then we always have exercised this, this strategy in gateway cities for business hotels. So if you see, majority of our revenues come from large gateway cities like Bangalore, Hyderabad, Pune, Delhi. And we feel that a very large and fast-growing pool of office assets and airline industry in these cities is a good feeder to hotel demand. So those are the 3 pivots for us: that 1, acquisition-led strategy; 2, very strong brand partnerships; and C, doing it in large markets where there's a very strong base of hotel demand catalyzed by office space and airline industry. So that's really a quick summary of our business, really, what we do and how we build the business. So the revenue model is very simple. Because we are the asset owners, all of the revenues come to us. We own the entire profit and loss statement of the company. What we do is that, of course, there are operating expenses, payroll, cost of goods sold, utilities, maintenance, variable expenses. Then also there's a fee that we pay to the operators and the brands. And that fee, typically the total direct cost towards base fee and incentive fee will be about 5% of the total revenues of the company. So that's really the model. In terms of overall financial performance, if you see, we have grown substantially from FY20 till now. Our total revenue in the current fiscal year is about 964 crores. I'm talking about fiscal year 2023. So total turnover of the company was about 964 crores. And total EBITDA was about 311.5 crores. So that's really the summary financial performance of the company. And this has been a substantial improvement over FY20, which is the last reference point pre-pandemic. In that year, our EBITDA was about 172 crores against an EBITDA of 311.5 crores in the fiscal year 2023. Our net worth has now, on a pro forma basis, become positive post the acquisition of the ACIC portfolio. So even though in the FY23 financials, you see a negative net worth, but if you look at our RHP, you would see a pro forma net worth also, which has turned positive, right? With the recapitalization of the company through the IPO proceeds of 1,200 crores, you obviously see a substantial improvement in net worth post IPO. So the net worth issue has already been addressed through the acquisition of the ACIC portfolio. In addition to that, the net worth will further significantly improve with the proceeds coming from the IPO. So that's part one. Let me now address the issue of the losses in the fiscal year 2023. So if you see in FY23, with a revenue of 964 crores on a pro forma basis, EBITDA was 311 crores and total losses were about 366 crores. Of these total losses, that the loss between, whatever has been lost between EBITDA and PAT, a large contributor to that was actually the finance cost. So the total finance cost in a P&L was about 569 crores. Of that 569, and what's really important to note is about 297 crores is non-recurring cost, which you will not see come through in the current fiscal year or in subsequent fiscal years, right? So first, significant improvement happens in the PAT level when you see compare, let's say, the current fiscal year with the previous fiscal year, where you will not see the one-time non-recurring finance cost, right? Two, the recurring finance cost. If you see the total net debt on our company's balance sheet was about 2,833 crores as of March 31, 2023. The total IPO size is 1,200 crores. Almost 1,100 of that is being used to reduce the debt. So our net debt post IPO will be more in the range of 1,730 crores against 2,830 crores that you have today. You will realize that at that reduced debt level, even our recurring finance cost would substantially come down from the current 272 crores. So we actually expect a significant reduction in the finance cost of the company because A, we have eliminated all non-recurring finance expenses that occurred in FY23. Two, majority of the IPO proceeds are being used to reduce the debt in the company. And with that much reduced debt, you will realize the finance cost also comes down. And once that has happened, the company has been well set on a path for profitability. So first is net worth. So as I said, on a pro forma basis, our net worth has already turned positive. If you see the pro forma financials, which are part of the RHP, on a pro forma financials, net worth is already positive. The second is that the recapitalization of 1,200 crores of primary proceeds will further all go towards adding to the net worth. So as after the acquisition of the ACIC portfolio, our net worth has turned positive. And on top of that, you'll have additional 1,200 crores of capital issuance through the IPO proceeds. So the net worth issue is being absolutely resolved. You will see a reasonably good net worth in the company. Similarly, in terms of PAT losses or profitability, I was explaining that in FY23, a large part of the losses were on account of very high finance cost because we were EBITDA positive. Our EBITDA was about 311 crores. Our total depreciation is just about 129 odd crores, right? So the PAT losses are largely on account of very high finance cost. They are split into two parts. One is about a 297 crores of non-recurring finance cost. So that happened in FY23 because there were certain convertible instruments that either got converted or got redeemed, and there was mark-to-market losses that we had to take, right? That's a non-recurring cost that has already been a past for us in FY23, will not get repeated in FY24 because none of those instruments are continuing now. In FY20, our revenue was 627 crores. Our EBITDA was 172 crores. Our net debt was 2,120 crores. Our total finance cost is about 208 crores. And therefore, the PBT, because effectively there's no tax, the PBT was about 162 crores in that year. If you compare FY20 to FY23, our revenue, as I said, is 964 crores. Our EBITDA is 311 crores. If I was to give you the numbers of the balance sheet post-IPO, our net debt will be in the zip code of 1,733 crores instead of 2,100 crores, right? I would resist to give you a finance cost because there'll be some changes in cost of financing once we pay off the high cost debt, right? So I think there's a significant improvement from FY20 to FY23. Our EBITDA is 311 against 172. Our net debt will be 1,733 against 2,100 crore, which was pre-pandemic. We saw a significant improvement in performance of hotels right through FY19, FY20, other than the COVID impacted period, which started in March of 2020, right? So from April of 2019, we had started seeing a very strong recovery. Occupancy levels were good across markets. Rates had started to finally improve after a very long, almost stagnation, so to say, right? What we are seeing is that the supply growth has kind of reduced substantially. So there's a huge supply which came between 2008 and 2018 almost 50,000 rooms across India became 150,000 rooms, right? So significant supply growth. But from 2018 onwards, we've seen the new supply really moderating. Today, it is in the zip code of 2 to 6% annual CAGR, right? Whereas the demand growth has continued to be in the zip code of 8 to 12%, because that's really coming from airlines, travel and tourism, growth of the office space, right? So because the demand growth since 2017, 2018 has been almost twice as much of the supply growth, what we have seen is a very quick stabilization of the occupancy levels. So in FY23, for instance, our occupancy levels have now touched 73% on a portfolio-wide basis, right? Our average route rates, if you see, have grown quarter on quarter from first quarter FY23 to quarter 4 of FY23. Every single quarter, we've seen a linear growth in average room rates, right? And that's not a surprise because our presence is concentrated in Bangalore and Hyderabad and Pune and Delhi and Ahmedabad. And all of these cities are the direct benefactors of what's happening to Indian economy, right? So we actually feel that the demand supply gap in India is squarely in favor of the hotel companies, right? The economic growth, the growth of the office space, the growth of the airline industry, the make in India, manufacturing focus in India. I think all of these factors are contributing to increased demand, and I don't think supply is able to catch up, at least in the key gateway cities. So we see pretty strong prospects for the sector, and more so in the gateway cities across India. As much as, it is very equally attractive in tier 2 and leisure destinations, but we are very focused on business hotels and gateway cities. So my comment is limited to that, honestly. So I think we'll stick to markets which offer us a very large pool of office assets. And I'm sure the growth of the office space is also expanding across cities in India. I mean, 15 years back, we only talked about Delhi, Mumbai, Calcutta, and Chennai. Today, we talk about Bangalore, Hyderabad, Pune being equally big, if not bigger, actually, right? And Ahmedabad has emerged in the last decade or so in terms of a critical city in India. So we will continue to see more cities emerging to be large economic centers in India, and we will follow that growth, right? But on an immediate basis, our growth is going to come from, first of all, a lot of growth is internal to us. We are adding 600 rooms to our portfolio over the next few quarters. And all of the assets are today owned by the company where this addition will happen. So we're adding an asset in Navi Mumbai, 350 rooms. And I think Navi Mumbai is a great market for the future because of the new airport. We are adding a hotel in Calcutta, and we are seeing a really good growth in Northeast and in Calcutta. We are adding rooms to our hotels in Bangalore, Chennai, and Pune. So we are adding about 600 rooms over the next few quarters. And as I said, all of these hotels are today with the company there. We don't need to really acquire anything. Then we are also renovating about 900 rooms in our portfolio. And we've seen in the past that every time we've renovated and rebranded a hotel, we've seen a significantly improved performance from such hotels, right? So for the next several quarters, we are very, very comfortable about the fact that most of the growth is going to come from within the existing portfolio where we have already made capital investments, right? So a lot of these assets which are producing no income today, right, actually are part of our asset base and including the debt. To that extent, it also addresses future concerns because these assets, once opening, will also add incremental EBITDA to our current EBITDA, right? So I think in the near future, our focus is on gateway cities, metros, business hotels. We can operate across price points, right? So we can have a Holiday Inn Express kind of a hotel at a mid-scale level. We have Fairfield by Marriott and 4 Points by Sheraton in the upper mid-scale. Then we have the upscale hotels. So we can go to a large city and densify that city with multiple hotels at different price points. So because of that ability to have hotels at multiple price points, we often are not forced to look at a smaller market just for growth because we can get that growth from the large markets itself. First of all, as I said, pricing in a company which has had losses in the immediate past is through a book building process, right? So 75% institutional investors. So the price band that we've announced is largely the resultant feedback from a large majority of institutional investors, right? That's one. Two, if you look at a price band ad, I would like you to really focus on one comparable, which is EV/EBITDA. Now, because of the balance sheet noises that I spoke about, non-recurring finance costs, high cost of debt, which is being, high debt pre-IPO, being corrected post-IPO. So the balance sheet ratios will change substantially, Chitranjan, pre and post-IPO. And therefore, I would always caution people to look a little deeper into how to really address this business. But there is one matrix which is independent of the, I would say, of that pre and post-IPO balance sheet issues, which is the EV/EBITDA, which is enterprise value, the business value to the EBITDA of the company, right? If you see on that matrix, we at the upper end of the price band, this IPO is priced at 14 times, 14.07 times of FY23, right? Our peer average is 26 times. So if you look at the peer average EV/EBITDA for FY23, their enterprise value to the EBITDA is about 26 times. SAMHI is being priced at 14.07 times. So in our opinion, and I think each investor will take its own view of whether it's attractive or expensive. But in our view, EV/EBITDA is a very clean ratio. And on that count, we have left a very, very large margin of safety for investors to participate. We remain fairly excited about the sector. I think our hotels are located extremely well, carry strong brand, which is reflected in their 73% portfolio-wide occupancy. Our operating margins are good, but growing materially year on year, right? So if you see our operating margins as the revenue growth comes in, are growing materially year on year. I think the only concern one may have is on the balance sheet when you look at the FY23, and we are taking a bold step of addressing that by materially reducing the debt by almost 1,100 crores through the primary proceeds. So originally, our DRHP was filed with 1,000 crores of primary. We upsized it to 1,200 crores in RHP, right? And as I said, majority of that, other than the IPO expenses, going towards deleveraging the balance sheet. So I think we are addressing one thing which could have been a matter of concern, and I hope that will bring a fair degree of comfort to a broader set of investors.